recession, right? Start using the service, they have in order to save some money, they cut back. The assumption here was that Snowflake would be a lot more volatile than its cloud companies. Now, I don't blame anyone for thinking this because it seems almost self-evident. When you look at the analyst downgrades and price target cuts from earlier this month, they were all worried about declining usage rates as the economy heads into a recession. These analysts are not clowns. They checked in with Snowflake's customers and sales partners, and the story they told was generally less positive than it had been a few months before. Didn't help that the stock's always been very expensive. But then Snowflake reported last Wednesday night, and the results were truly magnificent. I know, I was shocked. The company delivered much higher than expected revenues. They're up 83% year over year. Their operating income came in positive. Wall Street was widely expected to be negative. Look at that, went from a loss to a positive. They also gave robust guidance for the current quarter and even raised their full-year forecast. Forget doing worse. Snowflake obviously is in better shape to do incredibly here. Everybody was worried about the usage-based pricing model, but on the conference call, CEO Frank Slootman, long in favor of Mad Money, explained that it's a huge asset, not a liability, because it helps win lots of new business even when the economy's slowing. As he put it, they can sign a contract with us, but then they can throttle up or down how much they want to use. You can't do that in a software as a service model. You're going to pay no matter what, whether you're using it or not. So this gives customers actually more confidence to contract with us, knowing that they can throttle up and down. You know, it's such a good point. I'm surprised these analysts who downgraded didn't get that. That's just so key. You can decide to use more, to use it or less. At a time when so many cloud software companies are wringing their hands about more measured customer buying or elongated sales cycles. Remember, I gave those definitions last week, meaning it's much harder for them to win new business, which often requires that 3-year commitment. Snowflake's winning lots of business because their model's low commitment. CFO Mike Scarpelli went into more detail. He explained that new customers typically start small, then take about 9 months to really start to consume. You can sign up, try it, then if you like it, you scale up. If you don't like it, you stop using it, and there's no problem. A lot of these new customers have an on-demand model, so they're not on the hook for anything if they don't want to use it. That's fantastic. After the conference call, Slootman came on our show, and he made such a compelling case. Listen to this.
I think the model actually works better in a down market where people are, having headwinds and trepidations and not knowing which way the world's going to go. You like the elasticity, being able to throttle back, throttle up. When you have the confidence in a traditional subscription model, you don't have that luxury.
That is so smart. Well, no one ever said Slootman wasn't one of the smartest people in the business. Ever since the quarter, the stock soared, and the analysts have turned a lot more positive. Snowflake pulled back a lot today. Okay, it's down nearly 6%, but it's still up huge versus last Wednesday, which is what matters. Where do I come down on this one? I think it's crystal clear that Snowflake's oddball business model is much more resilient in a downturn than most of us believe. They're thriving at a time when some great software as a service companies are struggling to draw up new business. This has been Snowflake's story all along, but hardly anyone believed them until they reported last week. Unfortunately, though, the stock is still very expensive, selling for roughly 22 times next year's sales, when we have a lot of companies we like that are selling at 22 times earnings. So that makes Snowflake vulnerable if Jay Powell follows through in his comments last Friday and keeps slamming us with aggressive rate hikes. If Powell really goes full on, almost nothing gets sold. Whether you're using Snowflake's model or the older software as a service one, or even an on-prem one, a severe recession kind of does ruin everybody's model. Hence the pressure this whole cohort is under. It is ugly. The bottom line, Snowflake was attractive last week because the stock got too beaten down going into the quarter. If you like it, I think you should wait for the next analyst group freak out and drop, because when they do, they drive the stock down. And they're going to give you a better entry point than you'll have right now after this massive run. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky is the limit. It's a fast-fire lightning round. Next.
This looks like it's going to be a great start to September. We'll probably see a bit of a decline in October and an outperformance for the end of Q4. Let's see what's going on in the markets today. Let me see if I can get a insight review here. We've got a bearish chart that's been forming of the S&P, pointing to even more downside. Again, thinking that downside is going to take place in October, but we'll ride that wave and continue to actually see an upside come November, December, based on the historical data. What else is going on here? Biden's going to be speaking soon to the nation. That will be taking place, I think, tomorrow. We'll have to double check on that. Let's see what else we have going on here. On an LG Energy Solutions is planning on building a $4.4 billion battery plant in the United States, which is going to be pretty insane. The Fed rate hike won't bring down inflation as long as the government is pending to stay high. So we'll see what happens. We saw the Fed make an announcement earlier in the week that they are going to be raising the interest rate and won't be reducing it anytime soon. We're going to have to look at the data. The data is going to have to drive what's happening there. Let's see here. We're booking profits right now in the oil stock trading. It's near a 52-week high. Today, we were told that investing in oil, investing in energy, investing in commodities is the way to go. So pay attention to that as we move forward. Let's see if Jim is back here. Nope, we're still not back. Let's take a look here. Where are we ending at for the end of the day? Tesla's down by 3% or 1%. Down for the day. Down for the week. Apple's also down by 1%. Consumer discretionary sector is outperforming the quarter. Here are the analysts' favorite names. Let's take a look here. We've got Bed Bath & Beyond, which has been becoming just a massive meme stock. Not a fan of that. GM, Amazon, MGM Resorts, all looking good. Tapestry, Caesars, Lowe's, Target companies. TJX looking great. Let's see. We've got Home Depot, Ultra Beauty, Penn Entertainment, Tractor Supply, Hasbro, all looking to outperform as we move into Q4. Also, big news. Obviously, we were planning on the big NASA Artemis 1 rocket. Let's go back to Jim here.
It is time. It's time for the lightning round. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round is over. Drew in Connecticut. Drew.
Booyah, brother Jim. Great to hear from you. Longtime fan of the show, investment club member.
Yes.
Want to know what you think of Pepsi moving forward.
Pepsi goes in the bullpen. We think a lot of it. I just wish the stock would come down. Doesn't seem to come down at all, but it is well run and terrific. Dana in Nebraska. Dana.
Hi, Jim. It's great to talk to you.
Thank you.
Hey, what is your take on Kelly Services, Kelya?
Very well-run company. Right now, with people just feeling it's easy to get a job, you don't need them, and that's why that stock's been such a dog, but you never know. I am not a buyer of it right here, though. Let's go to Alan in Florida. Alan.
Jimmy Chill, booyah to you.
Booyah, right back at you. What's going on?
Jimmy, I've been hearing a lot of talk about nuclear being clean energy all of a sudden. Worldwide, I'm hearing this, and that it's needed to help us hit our clean energy goals.
Indeed.
Elon Musk is on board, Bill Gates, the Biden administration, and presently 20% of U.S. electricity is from nuclear that we primarily get from Russia. Seems to me like we're going to need some American uranium. What do you think about UEC?
Okay, now this is Canadian, and the problem with this group is so red hot that it is too sizzling for me. So I'm going to take a pass. I know the group's up 7%, the ETF's up 7% just today. That is too dangerous for me. I'm going to have to say no for now. Ed in Pennsylvania. Ed.
Booyah from the Pocono Mountains, Jim.
Oh, my. I love the Poconos. What's happening?
Oh, good times up here. Hey, I invested some mad money last year in a biotech company that focuses on rare liver diseases. Wanted your thoughts on Mirum Pharmaceuticals. Ticker symbol MIRM.
You know, I'm afraid they are losing too much money for me to recommend. And, you know, I feel so bad about that because when they're up like that, and they're doing some great work in that particular disease, especially with liver, I want to recommend it, but I just am afraid to because this had such a big move. Let's go to John in Oklahoma. John.
Hey, Jim. Inspired by your December 1st Mad Money interview with the company's CEO, my friend Amy and I bought a biotech stock which has since gone up more than 125% due largely to very positive phase 3 drug trial results. Considering that dramatic increase in value, would you say buy, sell, or hold Karuna Therapeutics?
We were believers. We were believers. Now, it does not fit my thesis about what works here, but we found ourselves very compelled and thought that it was an illness that if they could do anything for it would be great. So speculative, yes, it's a speculative situation. We've got time for one. We're going to go to Chris in New Jersey. Chris.
Mr. Cramer, a big
Yes.
booyah from State College, actually home to Penn State. I'm a long time
Penn State?
Yeah, Penn
We
State.
are all over Penn State. Jeff Marks, Penn State. What's up?
We are. I appreciate all your insight. I was wondering what you thought of Cloudflare.
I think that Matthew Prince is fantastic. The stock is low because they're making just very little money. I'm willing to bet with Prince. I think that that's one you can buy and put away. He does a good job. One more. Kara in Colorado. Kara.
Hey, Jim. It's Kara and Matt here from Colorado. We're huge fans, first-time callers. It's an honor to chat with you. Just wanted to know what you think about pulling the plug on Plug Power, or should we leave
No,
it?
it's okay. I mean, Andy Marsh was on again today. Andy Marsh, I think he must be a regular in the network because I see quite a bit of him. He's got to get that. Look, he needs something that is very elusive. It's called earnings. And if he gets them, the stock can still go higher. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by TD Ameritrade. Coming up, working from home or home free from working? Cramer works on a key issue among the labor force. Next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show.
All right. Another crazy flash round with Jim Cramer. Let's take a look and see what's going on here. So as I mentioned, we've had NASA postponing Artemis 1's rocket launch due to engine problems. So we actually don't know when the next attempt is going to be. It's a bit uncertain. So we saw that the launch was postponed. This is this massive rocket that's been awaiting a mission to the moon that we're all very excited about here at Carvalho Capital. We're pretty excited. NASA was able to resolve a temperature problem identified with one of the 4 liquid-fueled engines. The agency has a backup launch date scheduled for September 2nd and September 5th, but officials don't know whether the engine issue will be fixed before either of those dates. So NASA scrubs Artemis launch. Everyone is very disappointed about that. We're going to have to kind of see what takes place over the next few days. So we'll take a look at that. Stock futures do rise slightly after a second straight negative session. So we'll see what's going on. Stock futures ticked higher on Monday evening as Wall Street sought stability after another down day for stocks. Futures for the S&P 500 inched upwards by 0.1%, while the NASDAQ 100 futures also added 0.1%. Futures for the Dow Jones Industrial Average gained 41 points, or 0.1%. The moves in the futures followed a second straight decline for the majors average. The Dow lost 184 points, or 0.57%. The S&P 500 fell 0.67%, and the NASDAQ composite sank 1.02%. Look, the market has given back some of the summer gains after recent comments by the Fed Reserve's officials made it clear that the central bank aims to continue its rate hikes even if they cause economic pain. That happened on Monday. Look, investors are coming back to terms with the idea that the Fed is serious about curbing inflation, even as recent data suggests inflation is starting to decline. We also know that, look, the market's summer rally was inferior. We continue to recommend that investors remain selective and focus on defensive stock sectors like healthcare and dividend-paying stocks. On Tuesday, investors will get several updates on the state of the economy, including the FHFA Home Price Index for June, the Conference Board's Consumer Confidence Survey for August, and the Bureau of Labor Statistics job openings for the release of July. So very exciting. Also, what we've seen, oil prices rebound in the late of August. Literally falling for most of July. We saw oil rebound. The price of oil started to make a comeback. Oil prices settled up at 4% on Monday, and the futures for U.S. benchmark West Texas Intermediate crude is now trading above 96 per barrel. Again, let's go back to Jim.
I get why this happened, and I get why people like it. But from a business perspective, letting people work from home all the time is distinctly suboptimal. There are reasons why we go to work in person: collaboration, training, holding ourselves accountable, increasing productivity. On those scores, working from home is about a 1 out of a 10. I know it's a 10 out of 10 on personal convenience, but that's not what businesses pay people for. Now, it would be one thing if you could demonstrate a positive return on investment from staying home. There are specific cases where a remote setup makes sense. Maybe we could start to see the wholesale decline in rents that we keep hearing about. If you could get that retreat from the office and have all those commercial buildings turned into rentals, as is the case all around downtown, I can justify going remote from a point of view of the economy. It would help Fed contain inflation. But I don't think that's what's happening here. In reality, we've got sub 4% unemployment, which means CEOs simply don't have the power or the leverage to stop this. They know remote work is worse for business. They simply don't have a choice if they want to attract employees. So they make up a lot of nonsense about how it's good, even though when I talk to more CEOs than anybody else, they almost universally scorn it behind the desk, in the bar. They can't stand it. They just don't know how to stop it. They can't keep their people if other firms offer a day or two of extra time away from the office. Who doesn't want a 3-day weekend? I think people got a taste of freedom from COVID. And as long as we have a tight labor market, they're coming back in person. Some of you probably think I'm a fossil who simply demands physical presence as a way to demonstrate authority. But man, there are some things that are much harder to do remotely. As someone who has managed hundreds of people in my life, I watch in total dismay as this work from home continues, even though the COVID vaccines mean there's no longer a public health justification any worse than the flu. Call me old-fashioned, but I feel like there should be a place where you work together with your colleagues and collaborate and get to know the culture. Let me give you a perfect example. When I worked at Goldman Sachs in the 80s, I was tasked to help create a retreat so everyone in private wealth management from around the country got to meet each other. We knew that if we all got together, we could share context, learn from each other, get to know how the firm works, the ethos of the firm. And it is very much had a lot of ethos. I'll tell you, it made us much, much better at our jobs. I think that we need to have a more serious discussion in this country about the pros and cons of remote work. I know that businesses currently don't have much of a choice, but I think millions are in denial here. For most, if not all, the job gets done best at the office. With the crest of the pandemic wave, we need to acknowledge that remote work is a lot less efficient. Executives don't have a choice right now because of the labor shortage. Don't kid yourselves. They're allowing work from home or partial work from home because it somehow makes sense financially. It doesn't. It's so much more expensive to train someone remotely rather than doing it in person. Unless they can close offices and save money and nobody really needs to see or interact outside of work with anybody else, a hard call. Don't believe the work from home hype. It's not more efficient, although from the perspective of someone who works for a living, it's obviously great to have a lot of leverage. I'll tell you one thing for certain. Workers have not had this upper hand like this for as long as I can remember. Good for them. Jimmy Hoffa's dancing in his unmarked grave. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. The news with Shepard Smith starts now.
A weekend of violence in cities across America.
All right, that's it for the close. Let me take a look and see if there's anything else that we're missing here for the day. I already mentioned that, look, tomorrow we're going to see the HFA Home Price Index. That's going to be showcased tomorrow. What else we've got going on here? We have the Conference Board's Consumer Confidence Survey for August, and the Bureau of Labor Statistics job openings release is also scheduled for Tuesday. Already chatted about oil prices rebounding in late August. We're going to see that continue. Look, summer gains continue to slip away. As of today, the Dow is down 2.27% for the month, 7.39% above its June low. S&P 500 is down 2.4% for the month, 9.9% above its June low. NASDAQ Composite is down 3.01% for the month, 12.88% above its June low. With that being said, we'll take our leave. We'll see you tomorrow, and keep checking this channel. Like, subscribe, share. We'll be back soon. Take care. Bye-bye.